Waiting until December to handle your RMD could cost you more in taxes than the withdrawal itself. And today, I'm going to be covering what catches many retirees off guard so you don't make the same mistake. If you're 55 or older and approaching or already in retirement, this video could save you serious money before December 31st. My name is Patrick Shope, and I'm the founder of Shope & Associates. We help pre-retirees and retirees navigate the complexities of retirement planning so they can make confident decisions and avoid costly mistakes. Here's what most people get wrong about required minimum distributions. They treat it like they're paying a utility bill. Just get it done before the deadline. But when you have substantial retirement savings, your RMD isn't just a withdrawal. It's a strategic opportunity. The difference between handling it reactively versus proactively can cost you significantly. So today I'm going to walk you through 5 expensive mistakes I see retirees make with their year-end RMDs. By the end of this video, you're going to have a clear action plan to avoid each one of them. Mistake number 1, taking your RMD from the wrong account. Here's the most common mistake. You get that notice from your 401k provider in November reminding you about your RMD. You call them up, you tell them to send you the money, and consider it handled. But if you have multiple retirement accounts, you might be leaving serious money on the table. So imagine Robert, age 74, has 2 accounts, an old 401k from his previous employer with expensive fees and limited investment options, and a rollover IRA with low-cost index funds. Both accounts have roughly the same balance. And as a side note, you can aggregate RMDs across your own IRAs, but each 401k must satisfy its own RMD. You can't take a 401k RMD from an IRA and vice versa. Satisfy the 401k's required amount from the 401k itself, and then if you want a clean house, take any additional withdrawals from the higher fee plan first. Mistake number 2, missing the December QCD window. This one catches charitable givers by surprise every year. A qualified charitable distribution, or a QCD, lets you send money directly from your IRA to a charity. It counts towards your RMD, but doesn't count as taxable income to you. That's fantastic. But here's the common mistake. If you wait until mid-December to initiate your QCD, you're gambling with processing times. Here's exactly what to consider doing instead. QCDs can go directly from your IRA, not a 401k, to the charity and be completed by December 31st. Make sure you initiate this by late November to avoid custodian and mailing delays. Mistake number 3, triggering IRMAA when you don't have to. This is where a single decision can cost you significantly if not properly managed. IRMAA, the income-related monthly adjustment amount, is Medicare's way of charging higher income beneficiaries more for their Medicare coverage. So for 2025, that threshold is $106,000 for single filers and $212,000 for married couples filing jointly. This is based on your 2023 income, and it affects your entire 2025 Medicare premiums. The first bracket adds $74 per month to your Part B coverage and $13.70 per month to your Part D. Let's go back to Robert. Suppose his normal income puts him at $104,000, safely under the IRMAA threshold. But he takes his entire $25,000 RMD in December, pushing his total income to $129,000. He's now in the first IRMAA bracket, which means an extra $74 per month for Medicare Part B and about $14 per month for Part D. That's over $1,000 annually in additional Medicare cost, all because of timing. Now, while these examples are purely hypotheticals, this should get you in the mindset to start thinking about your own situation. Here's what you could do instead. Plan your total income early in the year, including your RMDs. If you're close to an IRMAA threshold, consider taking your RMD in quarterly installments or earlier in the year when you can better coordinate with other income sources. Now, if you're wondering how your specific numbers play out with these IRMAA thresholds and RMDs, we have a free tool that maps it all out for you. It takes about 5 minutes, requires no commitment, and isn't personal advice. It's just a general snapshot of where you stand. The link's right below in the video in the description. Mistake number 4, the Roth conversion coordination disaster. This mistake happens to people who are trying to be strategic but aren't looking at the complete picture. Many retirees want to do Roth conversions to reduce future tax burdens, but if you're not factoring in RMDs, you can accidentally push a large portion of your conversion into a much higher tax bracket. Here's how this could unfold. You calculate that you have room to convert $40,000 to a Roth while staying in your current tax bracket. You execute that conversion in November. Then you remember your $20,000 RMD and take it in December. Instead, consider calculating your total income first, including your RMD. Then determine the precise Roth conversion amount that fills up your targeted tax bracket. Think of your income as filling buckets. The RMD takes up space in those tax bracket buckets, so you got to plan accordingly. Also, once you're subject to RMDs, you must take the year's RMD before converting. RMD dollars themselves, they can't be converted. Mistake number 5, the December rebalancing tax mistake. This final mistake often happens with the best of intentions. You take your RMD in cash, then you realize your portfolio is completely out of balance. So you sell off some of those appreciated stocks to rebalance. Without realizing it, you just created an unnecessary taxable event. Let's say that you need to take a $30,000 RMD and you want to reduce your stock allocation. If you take the RMD in cash and then separately sell appreciated stocks held in a brokerage account, you'll pay capital gains on any appreciation. Instead, you might want to consider satisfying the RMD by distributing appreciated shares in kind to your taxable account. You'll still owe ordinary income tax on the share's fair market value at distribution, that's your RMD, but you avoid realizing a separate capital gain from selling this year. Your new cost basis equals the value on the distribution date. You see, these 5 mistakes might seem independent, but they often compound on each other. A retiree who makes all these errors can easily cost themselves substantially in a single year. And remember, some of these costs, like IRMAA, continue for the following entire next year. So they last for 2 years. The solution is treating your RMD as part of your overall tax and income strategy, not as an isolation task. If you're managing substantial retirement assets, consider creating a year-end RMD checklist or reviewing your strategy with a financial professional who understands how these different pieces work together for you. Your retirement assets represent decades of hard work. Don't let last-minute decisions erode what you've built. Take the time to plan your RMD strategy, and your future self will thank you. If you found this information helpful and want to see more of this type of content, please hit that like button and subscribe to our channel. It helps us to reach more people who need this type of information, and it also helps you by ensuring you don't miss out on our latest strategies for managing your retirement income. Again, this is Patrick Shope. I'll see you in the next video on Thursday. Bye for now.